Let's talk about the debt markets. Alphabet, the latest company looking to raise debt to fuel AI spending. It's looking to raise $3.6 billion specifically in what would be the biggest ever sale, or its first ever sale, rather, in Australia. Joining us now is Bloomberg Intelligence tech credit analyst Robert Schiffman. Robert, can we first, before we get to the kangaroo bonds, pick up on that point that Ed left off on, of the ability to get funding in this bond market and the off-balance sheet borrowing that's happening? How much of that speaks to something that's not circular financing concerns that's happening among the private credit players, that there's enough sort of in this ecosystem that it's not concentrated?
Sure. You know, Ed is talking about points of validation for AI. And all we keep seeing, I think, are bullish data points of explicit success. How AI is starting to be monetized and monetized in size. Yet all we want to talk about in general is about how bad things are, how it's a house of cards, circular financing, how this is a setup for collapse. And I believe it's absolutely the opposite. The way that these hyperscaler CEOs are talking about demand exceeding supply, we continue to see that in the bond markets. It's in all different forms, whether it's public, private, on-balance sheet, off-balance sheet. The real question is simply, is there enough capital around the globe to build what these CEOs see as their vision? And my answer is yes. And the bond markets are proving that in size.
There's enough capital in the world, but how much of it needs to be coming from different sources than just public bond markets, just given the insatiable appetite of these hyperscalers and how much they want to spend?
Well, we're seeing it from a wide variety of sources right now, just in the unsecured markets alone. If you look at what Alphabet has done, they've borrowed a little over $75 billion of bonds, but that comes from the U.S. It comes from Swiss francs, sea dollars, euros, British pounds, and now these Aussie kangaroo bonds. I just think there's a lot of money chasing after the potential growth that we see. And the real question, again, is, are you going to see that growth? The answer is yes. Now, when you add on top of those unsecured deals, these SPVs that we're seeing, when we're seeing true third-party money, like the largest private equity and credit shops in the world are now raising $500 billion. I actually think that's a little bit of a spit in the bucket. We're going to probably see those numbers triple. And where is that money coming from? It's exactly what Ed said. It's pension funds, it's insurance companies that have long-dated liabilities, and now they want to put those assets to work, and they're getting real yields now to take the risk of primarily AA names that really don't have that much risk.
Is that money, though, getting sucked out of other parts of this market, be it treasuries or other parts of the corporate credit market? Is all of that money getting crowded out by the need of the AI spending?
Well, not really. I mean, if you look, first of all, in the equity markets, right? Alphabet is also in the process of raising $85 billion of equity. SpaceX obviously did. Anthropic is going to come. OpenAI is going to come. We've already seen names like Oracle issue equity. You're going to see more of that, I think. What's happened to most of those stocks? They've been a little bit roller coaster rides, but overall, they're up, and they're up in size. So I think there's a lot of capital coming from the equity side. When you think about it from other pools, I think there's a variety of these other pools that continue to exist as well. And we're going to continue to create very creative ways of both borrowing and capital raising from equity and credit sides.
Well, I guess part of my question is also, does it disrupt wider financial markets? An argument could be made that last week Treasury yields went higher despite the fact we had softer CPI. And maybe the reason they're going higher is because the market needs to absorb the supply coming from hyperscalers.
Yeah, I think that reads great in an article, but in reality, it's not so much the truth. I mean, we've seen $1 trillion plus high-grade bond issuance year after year after year. So incrementally, maybe we're a little bit higher than we were last year, 25% higher, and a big chunk of that is in hyperscaler, so we're getting such enormous publicity. But the reality is, banks raise $600-700 million a year, and nobody says anything about it because the credit quality is there and the cash flows are there. Do people sell treasuries when they buy corporate bonds? Yes, a big chunk of real money players do that. But is that what's overall affecting treasury rates? I think if you have Ira Jersey on here, I don't think he's saying that treasuries are where they are because of corporate bonds. They're there because of other inflationary pressures and lots of other big macro things that are going around the globe. So if you want to blame everything on AI, go ahead. But I don't think that's why where rates are there, where they are.
A welcome dose of reality, Rob. Thank you so much for joining this morning. Great to see you. Robert Schiffman of Bloomberg Intelligence. Let's get